Morning, everyone. My name's Aaron Hemmington. I'm a tax director here at Horsens, and I'd like to welcome you all to the Horsens Finance and Innovation Forum. This is the first in a series of events where we'll be looking at financial issues and opportunities in relation to companies engaged in innovation. So today I'll be talking about R&D tax relief, and I'm pleased to welcome James and Xavier from Rocking Horse Group, who will be presenting their innovative finance solution for companies engaged in R&D. So we'll be taking questions at the end. So if I could please ask you to type your questions in the chat and just indicate whether the question's directed at Horsens or Rocking Horse. Okay. Space. Right. Right, okay. Okay, so today I'm going to be talking about research and development tax relief. The relief has been around for around 20 years now, so quite a long time. And I think, to be honest, it's still one of the most overlooked tax reliefs around. So if we just move that on to the next slide. Thanks. Yeah, so in 2018-19, there's around 1.5 million companies that filed CT returns. And of this amount, only about 59,265 R&D claims were made. Therefore, it's only around sort of 4% of companies that are claiming R&D tax relief. So it's quite a small number. So it kind of gets you thinking, well, maybe more people could be making those claims, and why aren't they making those claims? So today I'm going to look at the reasons why people might not be making claims. And then we're going to look at actually how some of the schemes work. So we'll look at the amount of relief available under the SME scheme and the RDEC scheme. We'll look at the costs that qualify for relief under each of those schemes. And then we'll look at some particular issues regarding contracted out R&D, grant funded R&D, subsidised R&D. And more recently, we've had some issues with regards to some of the CBILS loans that people have been obtaining. And we'll look at how they can impact on people's R&D claims as well. Okay, so when is R&D tax relief available? It's only available to companies. It's a corporate tax relief. And to obtain R&D relief, companies must aim to achieve an advance via the resolution of scientific or technological uncertainty. Now, this is where the issue is, I believe, and this is where a lot of people are ruling themselves out because they're thinking, well, maybe, you know, what I've come up with isn't exactly new. There's a competitor that's done something very similar, you know, surely we can't qualify. However, the revenue do say in their manuals that, you know, competitors may have tried to do something very similar, but if the knowledge on how to achieve that advance is not in the public domain, then, you know, a claim may still be valid. So I think it's very important to sort of focus on that when you're sort of considering whether you qualify or not, because I think once you take that into consideration, it suddenly brings a wider scope of companies into being able to claim the relief. Okay, so if you've developed new tools, products or services, or you've tried to improve existing products or services through technological changes, or you've experimented with new equipment or production techniques, then, you know, there's a pretty good chance that you might qualify for relief. So just have a look at all your activities and see if you're ticking any of those boxes. Okay, so the amounts of R&D relief available really depends on the size of the company or the group, if the company is a member of a group. So if a company is not large, then the SME scheme will apply, unless the R&D is grant funded or subsidised or contracted out. If a company is large, or you've got an SME with grant funded or subsidised R&D, then the RDEC, Research and Development Expenditure Credit Scheme, will apply. And so we'll look at each of the schemes in turn, but first we'll look at what the definition of a large company is. Okay. Just go back, yeah. So a company or group is large if it's got 500 employees and either a turnover of 100 million euros or a balance sheet total of 86 million euros. Okay, so you have to look, if a company is a member of a group, you have to look at the group as a whole and compare the financials and headcount of the group to these limits in ascertaining if that company is large or not. However, we also need to bear in mind the partner enterprise rules, and I think these probably get overlooked quite a lot. And that's where you have to bring in a proportion of the headcount and the financials of partner enterprises. Now, very broadly, the partner enterprise is where, say, company A owns 25% or more of the capital and voting rights of company B. And if that's the case, if company B wants to make a claim, it has to bring in, the relevant percentage of company A's headcount and financials, and add those to its own data in considering whether it's exceeded the limits or not. And this is an issue that we've recently come across with a very large claim we were working on, where the company had some investment from an overseas company, and that overseas company was continually increasing its shareholding each year, to the point where last year I think the shareholding went over 25%. Obviously the alarm bells then rang. Are we in the partner enterprise rules? And if so, how big is this entity, overseas entity? And how many employees do they have? What's their turnover and balance sheet total? And it's like, well, how are we going to find that out? But actually, in this particular case, we found that there was a let out for situations where you've got a venture capital company that's investing in a company undertaking R&D. Because if it's a venture capital company that owns more than 25%, then you don't need to worry about the partner enterprise rules. However, if the venture capital company owned more than 51%, then it would be a group, and then there wouldn't be that let out. You would have to bring in the value of its headcount and financials. So in summary, if a company is not large, it's treated as an SME, and the claim for that company should fall under the SME scheme. So we'll just have a look at how the SME scheme works now. Okay, so the SME R&D relief scheme allows SME companies to deduct an extra 130% of qualifying costs on top of the normal 100% deduction, to give a 230% deduction in effect. However, where that R&D claim creates a loss, then you can surrender that loss for an R&D cash tax credit of 14.5% of the loss, which is pretty good. However, just a note, from next April, we're expecting that the government are going to introduce a PAYE NIC cap. So any R&D cash tax credit will be capped at 3 times the PAYE NIC liability of the company. And broadly, that's been brought in because there's been a lot of very questionable claims that have been submitted over the last few years. And it's just one way, the government are looking at clamping down on some of those claims and the amount of tax lost as a result of those. Okay. So what costs qualify for relief under the R&D scheme? Employee costs, that's the biggest area in terms of our claims that we make, and probably many other accountants. It's the employee costs that form the large bulk of the claim, because obviously the manpower and time spent in carrying out the R&D. And in that regard, we can bring in salary costs, employer NI and employer pension. And what we're looking at there is looking at the amount of time that employees spend on R&D activities and trying to come up with a percentage which we can then apply to the employee cost to bring into the claim. And in terms of time spent on R&D, we're looking at time spent directly on R&D, but we're also looking at time spent on qualifying indirect activities. And qualifying indirect activities can include managing R&D staff, recruiting R&D staff, and budgeting for R&D projects. So if we bring those qualifying indirect activities in as well, it's starting to increase the amount we can claim. We can also bring in subcontractor costs. However, they're subject to a 65% restriction, so we only get the enhanced deduction on 65% of the expenditure. We can also bring in consumable items, materials and things that are consumed in the R&D process. However, due to a rule change came about 3 or 4 years ago, we can't include consumable items where they're included in a product which is then sold onto an end client. And that was brought in because I think there was a lot of companies building prototypes, including the cost of the materials in the prototypes in the R&D claim, but they were then selling the prototypes on for a substantial amount of money while still getting the R&D relief on the materials that had gone in. So obviously the revenue didn't like that, and that's why they've brought this particular rule in. We can also bring in costs for externally provided workers. Broadly, that's agency staff that are brought in to help with R&D. Again, that's subject to the 65% restriction. We can also bring in a portion of light and heat costs. So if you've got a factory or whatever, we can bring in a proportion of those overheads. We can also bring in the cost of software, which have been directly or indirectly used in the R&D process. And recently, the government of HMRC have also confirmed that we can also bring in reimbursed travel and subsistence costs, where, for example, an employee is had to travel somewhere to go to a meeting about an R&D project, and then they've claimed those expenses back from the company. Those expenses can now be brought into R&D claims. And also, just in terms of changes in regards to qualifying expenditure, we're expecting that next year we might be able to claim for data and cloud computing expenses in R&D claims, and that's something that's been going through a consultation. So hopefully we'll hear more on that in the new year, and that's going to be another area of expenditure that we can bring in to boost claims. Next slide. Okay. So this is just a really basic example, just to give you a flavour as to how the SME scheme works. So we've got a company, A Limited, qualifying R&D spend of £100,000, tax adjusted profit before relief of 500,000. So without the relief, corporation tax liability at 19%, that's 95,000. But if you look in the right-hand column where we're claiming the R&D additional deduction, we've got an additional deduction of 130,000, the 130% on that 100k of qualifying spend. We deduct that from the taxable profit, brings taxable profit down to 370,000. Corporation tax at 19%, 70,300. So that's reduced the corporation tax liability down quite nicely. Actually, the effective rate of relief there it's about 43%, which is sort of 230% at 19%, which is about 43%. To give you an idea as to the magnitude of the relief that you're getting there, it is really quite generous. Okay, next slide. And again, here's just a basic example of what happens under the SME scheme, where you've got a loss that's created by an R&D claim. Again, A Limited's got qualifying R&D spend of 100,000, but in this scenario, it's got a tax adjusted profit before relief of just £10,000. So without a claim, it's just going to have a CT liability of 1,900. But with the claim, that additional deduction of 130,000 coming in, we're creating a loss there, 120,000, which we can surrender for a tax credit of 14.5% of 17,400. So the value there of the claim is the 17,400 cash tax credit, plus the 1,900 of corporation tax that we're not having to pay as a result of that. However, it's not always the most beneficial thing to surrender the loss for an R&D credit, because, for example, if the company had made profits in the previous year, it could carry that loss back to the previous year and get corporation tax relief at 19%. Also, if the company was expecting to make profits in the following year, which would otherwise be taxed at 19%, why not carry the loss forward and get relief at 19% instead of 14.5%? Also, the company could be a member of a group, in which case, what about surrendering the loss to another group company under the group relief provisions? That then saves corporation tax at 19% as well. So although the cash tax credit is a good option to have, especially if there's no other means of obtaining the relief, you should always consider the other options as well. Okay. So now moving on to the RDEC scheme, the Research and Development Expenditure Credit Scheme. But this allows large companies to claim a tax credit of 13% on qualifying costs. That was 12% pre-April 20, so that's recently increased. However, as we sort of alluded to earlier, The RDEC also applies to SMEs where the expenditure is grant funded, subsidised, or it's contracted out by a large company. So let's just have a look at how the RDEC scheme works. Okay, so the RDEC of 13% on the qualifying costs is basically offset against the corporation tax liability for the period. If the company is loss-making, then it gets a repayable credit. However, the RDEC is taxable above the line, and in that regard, you're supposed to bring the RDEC, you can bring the RDEC into the accounts above the line. And the idea for that was that it kind of reflects the input of the R&D team towards the profitability of the company. So they thought it'd be better to put that credit above the line rather than below the line in the accounts. However, as a result of that, the RDEC is actually a taxable above the line credit. And the result is that the effective rate of the RDEC is actually now 10.53% and not 13%. So if you are a loss-making company, you can get that repayable credit, but the repayable credit isn't 13%, it's actually 10.53%. Okay, next slide, please. So what costs qualify for relief under the RDEC scheme? It's broadly the same as the costs that qualify under the SME scheme. The main difference is that it's subcontractor costs. So under the RDEC scheme, you can only claim for subcontractor costs where the subcontractor is an individual, a partnership, or a qualifying body. And if the subcontractor is one of those, you can claim for their costs, but there's no restriction to 65%. So you can bring in basically 100% there. And just to clarify what a qualifying body is, it'll be, you know, like a university or something like that. And quite often R&D, we do see R&D contracted out to universities in that regard. And again, all the areas of expenditure are pretty much the same, except for those subcontractor costs. Next slide. Okay, it's just a really basic example of how the RDEC scheme works. So we've got B Limited with a qualifying spend of 500,000. Without a claim, it's going to pay 190,000 of corporation tax at 19%. However, with a claim, so we've got 13% RDEC, 65,000, which we first have to bring in above the line in arriving at taxable profit. So that increases our taxable profit to 1,065,000. We then have to calculate the corporation tax at 19% on that 1,065,000. So that gives us a liability of 202,350. We then deduct the RDEC of 65,000 and arrive at corporation tax payable of 137,500. So a little bit convoluted, but that's how it works. But again, the effective rate of relief is about 10.53%. Okay, so now we're just going to move on to some particular issues, which I think are quite often overlooked, to be honest. And some of these issues we've come across in the course of our work on R&D. And the first one is that you might have an SME that's doing some work for a large company or an individual or partnership. Well, in that case, the SME can claim R&D relief, but it's not under the SME scheme. It's actually under the RDEC scheme. So it's going to be a lower rate of relief, the 10.53% effective tax rate, as we've just seen. Also, if an SME receives a subsidy or grant, then the amount of expenditure funded by that subsidy or grant falls under the RDEC scheme. So you can have situations, and indeed we've got some claims that we deal with, where half of the claim might fall under the SME scheme, but the other half, because it's been grant funded, falls under the RDEC scheme. Okay. Also to bear in mind, if the grant is a notified state aid under the EU competition rules, then the whole project will fall under the RDEC scheme, even if only a part of it has been funded by the grant. So where a company's got a grant, it's very important to check with the grant providers whether it's a notified state aid or not. In a lot of the claims we've been working on recently, the clients have been getting grants from Innovate UK, and they're normally like really helpful in communicating whether the grant is notified state aid. And actually a lot of the grants that they've been providing are block exempt. which basically means they're not notified state aid, and it's only the expenditure funded by the grant that falls under the RDEC scheme. Also, just moving on to something that's a bit more topical in light of what's been going on in the last sort of 12 months. Obviously, a lot of companies have been obtaining the CBILS loans. Well, actually, the CBILS loans are a notified state aid under the EU rules. So where they're used to fund R&D expenditure, the project falls under the RDEC scheme. And therefore, it's really important that, if a company's got CBILS monies, that it ring fences those monies so they're used on general expenditure rather than R&D expenditure. And it's also advised to be careful with CBILS applications. So if you're making a CBILS application, if you put in the application that you need the money for R&D, then you've just kind of shot yourself in the foot potentially for your R&D claim, especially if the revenue ever inquired into it and they asked to see that documentation. So there's quite a few issues there to be aware of. Okay. In terms of claims, claims must be made within 2 years of the end of the accounting period. The claims have to be included in the CT return and computations, and you must submit a financial and technical disclosure with the returns. It's really important you do that. If you don't, then there's a high chance you're going to get an inquiry. And broadly, I mean, the disclosure is just setting out what the aim of the project was, what the advance sought was, what the uncertainties were, how they were overcome and why they weren't readily deducible. And generally, we've found that if you include all that detail, then you won't get a query from the revenue. Provided, of course, you've got a strong argument that the company has aimed to achieve an advance and has had to resolve uncertainty. Okay, so just in summary, before I sort of pass on to the guys from Rocking Horse Group, you can be seeing that R&D relief, it's an extremely generous relief. It's probably the most generous of the tax reliefs out there. However, as we've seen, there's a number of complications and traps for the unwary. And therefore, it's essential to get advice from a tax professional. At Horsons, we've got a team of experienced professionals who are all well versed in the legislation, and we've made a number of claims, many claims for clients without challenge from the revenue. And I know a lot of people go around saying that, but we can genuinely hand on heart say that. So if you think you may qualify, then please do get in touch with either me, David Cairns, Craig Walker in Sheffield, or Stephen Charles, and we'll have a chat and see how we can help you. Well, I hope that's all been informative for you. I'm now going to pass on to James and Xavier from Rocking Horse Group, who are going to present on their innovative finance solution for companies engaged in R&D. They unmuted? You're right. Hi, guys.
Hi, Aaron. On behalf of Rocking Horse, we would like to thank Horsons for inviting us to speak, and in particular Aaron for leading this. So thank you very much. One thing is, luckily, Xavier and I are not here to discuss COVID-19 or US elections, which are still undergoing. But what we do want to talk about, and what we actually like at Rocking Horse, and we will explain why we lend against R&D tax credits and what makes us different. The big difference that we do provide is we lend to loss-making businesses. We lend approximately up to 80% of the total R&D tax credit, which obviously Aaron discussed on the full calculation of. And we really want to make sure that this capital is available for that business to either continue to grow and remain ahead of competition, or if in difficulty require a bit of working capital, that they are provided with that capital so that they continue to either defend their position or maintain the business under certain maybe skews or seasonal difficulty. With the actual loan itself, there are no financial ratio covenants required throughout the term of the loan. The fee structure is very, very simple, with an establishment fee and then an interest payment which made at the end of the agreement. The actual loan agreement is terminated immediately after a successful R&D tax credit payment from HMRC, or an RDEC tax credit. The most important thing is that there is no monthly servicing charge, so all payments are made at the end, and there is no mechanism that actually dilutes equity for existing holders of that business. We very, very much want to, and one of our key missions is to support UK SMEs, and we do not want to make sure that those shareholders are diluted under difficult circumstances. So we're very much supporters rather than vultures of businesses. On which note, I think probably best to hand over to Xavier to take through a case study to give exact sort of how we work and where we can help businesses.
Thank you. I'm going to start. We put this case study together because we often get the question, why should I borrow against my R&D tax credit? I'll just have to repay it. Why should I do it now? And so on. So this case study is very much to address this. We're going to look at a client of ours who makes this product. We had to put a little square just to blank out their name. They're fine with us using our name, but we just don't like to do it. Just keep it on a no-name basis. So if we can go to the next slide, please. Just a very quick overview of the business. They were founded in the mid-2000s. They design and manufacture specialist industrial parts. And initially, they thought they were going to be using combustion engines. And indeed, they have got a couple of contracts with large car manufacturers. But as I'm sure you've known since Dieselgate, car manufacturers have de-emphasized their R&D on combustion engines. And so this has been a problem for our clients in that their sales are going up, but not as quickly as they hoped and not as well as they hoped. They've got a very good product. The problem is their clients are de-emphasizing. So they kind of looked around and said, well, we've got a great product. What else can we use it for? And they found uses in fuel cells and industrial air applications. So on that note, let's go to the next slide. They found that for the fuel cell applications, there was a large airline OEM, aerospace OEM that had a bid in 2020 for a competition to basically make planes with fuel cells in them on a drive to carbon. Now, this is very, looking to the future kind of thing. But they thought, well, if we can partner with these guys, we've potentially got a very good business very early on. The problem is they're loss-making. They didn't have cash to fund yet another project. And this is why they approached us, right? And this is really the key message is if you've got, an ongoing pipeline of things that you're doing, and suddenly you're thinking, but there's this opportunity. It might be time limited. It might be seasonal. It might be something that you've wanted to go for, but you've not had the cash. That's typically why our clients come in. It's basically to grow faster, to add a new project, and so on and so forth. So we were able to help them with that because if we go to the next slide, they had a record. So the second line is the important one here. They had a record of having claimed tax credit. We only ask for 1 year prior. Basically, what we want to make sure is that the company, what they're doing at HMRC, will repay it. And so we lend them, in this case, 80% of their expected CT600. We lend them almost 4 months ahead of the CT600 submission. This is an important point. We don't have to wait. In fact, it's almost pointless to wait until your CT600 submission. You want to get the money early, and then we will only get our money back with interest payments when HMRC repays. And typically that's 2 months, sometimes it's 6 months. So we will just wait until that point. So typically our loans are 6 months, give or take. So very much it's a short-term bridge solution. But in this case, it worked perfectly for the company because they were then able to do the R&D to adapt their product for fuel cells. They won the contract, which was great. And now they're applying for an Innovate UK grant, which we might also be able to help them with. So if we go to the next slide. What do we do? So if you're a client and you're thinking, right, I might need this money, this would be a very interesting project. What is the problem? Because I know traditional banks are very unlikely to lend to me. And these guys might ask for more time than it's worth. So we do a due diligence process, of course, and the details are on there, and I'm sure you've seen the website. So I'm not going to go through them in too much detail, but basically we're going to look at the cash flow. We're going to look at what's the best case that can happen, what's the middle case that can happen, what's the worst case that can happen. And because our biggest risk is that the company overspends and runs out of money before HMRC repays them. So that's what we're going to establish. And typically there's a lot of levers that small companies can pull on to slow down cash burn if things don't turn out as they're planned. And we will definitely take those into consideration. And I think that makes us very different to normal banks in that, you know, we're a small business ourselves. We look at nothing but loss-making businesses, and therefore we are very, very understanding of how these things can, you know, go right or wrong. Let's go to the next slide. Establishment fee is typically 3.8%. APR is 20%. Now this is risky business. Up to 80% of the tax credit, and typically we ask that any money we've lent to you, you've already spent on R&D, i.e., that we know that that amount at least is kind of cornered and will be repaid. It's a bullet payment when HMRC pays back. It's up to 6 months before the CT600 submission, but typically, as I said, our clients take it 3 or 4 months before the submission. Should MRC turn down, refuse to repay the tax credit, now we only work with people like Horsons, which we know have a track record of not getting their submissions turned down. So we you know, but that's a risk for both us and the small company, of course. But that's why we're very restrictive on the amount of clients that, accountants that we work with, because we want to know that the tax refund will be repaid. And let's move on to the next slide on that note. Now, very often, if you're a small company, you are thinking, I could also raise equity. And we work with a lot of venture capitalists who very often say, well, we don't want to come in at this stage. It is better if you take a tax credit, or we want to, you know, you fund this project somehow, some other way, because it's too small for us, or the due diligence on us, you know, assessing this project will just take too long. So we work a lot with venture capitalists, and we kind of view ourselves as complementary to them. But we've just put a side-by-side comparison cost. And as James said, the key thing is we do not dilute the equity of the company. And generally speaking, if your project is going to be successful, which is the reason why you're doing it, you're much better waiting, borrowing the money to do the project, have it be successful, have the sales coming in, because then if you do need to raise equity, your equity value will be much higher because you'll have a lot higher for future sales. So that's another reason why our clients use us as a bridge, finance a project, finance or just use for working capital to accelerate current R&D. And then if they do come to raise equity later, what they find is that the equity value is much higher at that point. Let's go to the next slide. Those are our contact details. So I think that that basically sums up what we have to say. If you have any questions, I'm sure you can put them on chat.
I think.
Yeah, James, if you want to conclude, that'd be perfect.
I think if you just go back one slide, please. I think the most important thing is that while obviously there's the establishment fees and then the fees over the term of the loan, because they are in reality a bridging loan prior to the actual R&D tax credit amount, which could be because of equity raising or keeping projects going. As mentioned at the start, we terminate the loan with no fees, no exit charges immediately upon receipt from HMRC, and hence the total cost is arguably far less than any potential dilution of equity or missing out on revenue from that project in future years. So the total actual amount is, you know, with the short-term loan is relatively advantageous and keeps not only difficult businesses remain in business, but also fast-growing businesses growing quickly. So that's our real project.
Thank you. I think we've got a few questions in the chat.
From Andrew, thank you very much for that. For the actual loan, is there a geographical preference? No, we are completely geographic agnostic. We obviously, there's certain sectors, as I'm sure you all know, that have higher levels of R&D tax credit amounts than others. We are both sector and geography agnostic. For us, it's very much about the business itself, ensuring that the cash flows are okay and that the business, is moving in the right direction with correct projects and things.
In terms of Gary, is there a minimum or maximum amount that we will lend? Realistically, there isn't, but we tend to say if it's less than £40,000, it's just not going to be worth it. And the maximum amount, no, we've got a reasonably big balance sheet that we want to use and we have to use really for it to make sense for us. So I think if it was above £1 million, we'd start to get a little nervous and really have to do some heavy due diligence. But yeah, that's the range. And I'll say most of our clients are in the £100,000 to £200,000 range, but we've done as little as 40,000. That's the minimum, and the maximum a few £100,000. We've not gone to the £1 million yet. Does that answer the questions?
Any more questions for Rocking Horse Group before I move on to answering the questions on R&D tax credits? No? Okay. So, okay. So a question from Chris Fitzgerald. Is the PAYE NIC limit employers only or in total? Yeah, it's the total class 1 and the PAYE tax on that. Chris Worrell, does the CBIL rule apply equally to the bounce back loans? Yeah, the bounce back loans are also notified state aid. So there's also an issue there to look out for. Another question from Chris. Does the ring fencing idea apply equally to grants from county councils? Well, yeah, I mean, any sort of form of grants or subsidies, to the extent that they're used to fund an R&D project, is going to cause that expenditure to fall under the RDEX scheme. So yeah, if you didn't want part of your claim or all of your claim to fall under the RDEX scheme, then yeah, ring fence those monies, basically, is the answer to that. Another one.
As Andrew's also asked, are you sharing the slides? And Aaron, I'll let you answer that.
Right, okay, where's that question, sorry? Okay, so if anyone wants the slides, yes, we can send those around. We can send the full slides back to you all. Just send us a message and we'll drop those over on an email to you. That's not a problem. It's not a problem. Okay, if R&D requires training, for instance, using, yeah. So if you have to send, this question from David Wass there, thanks David. So basically, yeah, if you have to send staff on a training course for new software, that the time they spend going on that course can qualify as qualifying indirect activity for R&D. So yes, you can bring that into the claim, provided obviously they need to learn that software to work on the R&D, the qualifying R&D project that you're doing. So you can bring that in as well. Okay, that's covered all the questions, isn't it? Okay. Well, thanks everyone, and in particular, a big thanks to James and Xavier at Rocking Horse. I'd also like to thank Amy and Robin, our marketing department, for helping us put this seminar on. Also, just to note, our next upcoming event is our 2020 Winter Tax Seminar, which was scheduled for the 25th of November, where we'll be looking at some topical tax issues and changes. And that will be hosted by Stephen Charles, Craig Walker and myself. So it'd be good to see you attend that if you're free. And again, if you're interested in joining any more of our free events, please sign up through our website and we'll endeavour to notify you of those. But again, thanks very much for attending. I hope it's been interesting for you all. If anyone does have any other questions that they think of when they go away from this meeting, and please don't hesitate to contact me or your usual Horson's contact. And likewise, contact James and Xavier about any questions regarding the tax credit loans using the details that they've provided. But yeah, we'll get the slides sent around for you Thanks very much all, and enjoy the rest of your day.